go ahead and get that started. So, all right. So we got some stuff to cover today. I had sent out homework last Saturday, copy of it. Hope the Dropbox helps. I got a sheet that I'm going to put in there. I'm going to talk about in a second that I hope will help. We did it with some of our classroom sessions and kind of helping with a sheet to kind of summarize everything and put everything together so that you kind of have a spot so that you say, okay, so I got a foreign tax credit. Where does it go? How do I find it in tax-wise? Because a lot of times people, that's where they tend to fight. They get the understanding from the textbook, and they'll be able to understand the tax law, but all of a sudden they try to go in and take the document and put it into TaxWise, into the software to complete the tax return, and that's sometimes where the disconnect comes in. So we'll kind of talk about that. As I talked about too, and I mentioned in there, I know a couple people from the online have taken advantage of it. I know a couple people or more from my classroom sessions. When I'm not teaching in Lockport on Tuesdays and Thursdays, I am here at the corporate office in Tonawanda, and we have a computer lab here where we run classes out of, so people can come in, they can sit and work on problems. So if it's a matter of getting comfortable with the software, understanding how the forms work, and things like that, you can come in here, work on problems. I have extra problems that one of our other instructors, Karen, has made up that I can give you to work on besides what's in the workbook. So gives you a little bit more exposure. And then obviously, if you're here with me, I can work with you face-to-face. I know that's the difficulty sometimes with the online, is I don't get to see the face-to-face. I can kind of review things about the problems I've assigned you, making sure that you understand how they work, going through them. Obviously, you'll have the videos to come back to and review and see what's going on. But, you know, sometimes not having that face-to-face where we can work on problems directly. And like I said, I encourage you, if you got an hour or two, come in. We got plenty of computers. There's 20 plus computers back there, so there's plenty of room. The office is open Monday through Friday, 9 to 5. I am willing to stay late. Obviously, I can't on Tuesdays and Thursdays. Those are days that I'm teaching in Lockport. But on the other nights, if somebody needs to come in at 5 o'clock because they want to drop in after work and get some extra help, I am happy to do that. Also, I encourage you, if you want to set up a one-on-one Zoom session with me, we can do that too. So, you know, we can have the mics up and live and go right through it and make sure that, you know, you're grasping all the material. We're going to start to get into some things. Today we'll be working on capital gains and retirement. Tough reading for those of you that you know, the reading of the textbook and the Pub 17 and the different publications that support it. But, you know, we're going to really boil it down to the bare bones and the necessities of what you need to know about, and hopefully that you'll be able to understand it a lot better. So in most of the stuff that we'll do when we talk about those that we have is that we really are making sure that you know, you understand the core or the intent of the law and the tax code, I should say, and how to apply it to somebody's document tax returns. You know, if you understand the core and the thought process as to why it's done and how it's done, you know, using the forms and getting the information in there, sometimes will go a lot smoother. Okay. All right. Let's see here. We had what I assigned last Saturday was for you to work on the quizzes. Let's see here. We had the quiz for Chapter 6 and Chapter 7. So we're going to review those. We had a couple workbook problems, and like I said, going forward, trying to spend as much time doing different problems as I can in the time that we have so that you can see them going on, see what I'm doing with those, and then, like I said, hopefully the coming back to view the videos will allow you to review what's going on. Okay? All right, so let me get Chapter 6 up here. Okay, Chapter 6. Remember, we you know, covered in Chapter 5 our refundable credits. Those are those credits that are the good ones that once we get them, we get to keep them. They keep going on. Even if we get rid of our tax bill, they will continue on and become part of our refund. Thus the word refundable credit. These non-refundable credits are good credits, but they are credits again that once the tax bill is gone, they stop. Some of them do have characteristics that allow them to carry over to future years. Thinking of the adoption credit and the energy credit. But again, you have to have a tax bill to use these credits, and in order to maximize them, you got to have a tax bill that goes through that way. Okay. So, excuse me, 1 second. Okay, so we talked about the refundable credits in 6. The non-refundable portions of the child tax credit. You got to remember that it kind of is a hybrid, has the 2 pieces. You have the non-refundable portion of the child tax credit, and then the additional child tax credit, which makes up the refundable portion of that $2,000. Again, I talked about the foreign tax credit, American Opportunity Credit. Again, kind of a hybrid, has a refundable portion and a non-refundable portion. Okay, and then we talked about the lifetime learning credit. Again, that is a credit that is strictly non-refundable. It is limited, and so we have things on that. So, all right, so let's go down and go through the quiz. Let's see here. Come on, computer. All right, there we go. Okay, so we got the quiz on 6. Okay, so we're going to take a look at the quiz there, and get it up in front of me here. Okay, and we'll talk a little bit more as we go through the quiz, just talking about the various things that are kind of little nuances to each thing. So, speaking of quizzes and stuff like that, great job by everybody sending in the homework, sending in the problems. They look very good. I know it's a tough logistical thing with the PDFs, but it's the best way we can do it, getting those problems turned in. Okay. First question has, what statement is true concerning Joe, who is in the 24% tax bracket? This is kind of going back to when we were talking some of the stuff when we began talking about credits and deductions. And the answer is C. A $48 credit saves Joe the same in taxes as a $200 deduction. Okay, remember, those credits, they're dollar for dollar coming off our tax bill. The deduction, that lowers our gross income, lowers our taxable income before the tax is calculated. So it becomes a proportional or a percentage. It's not a dollar for dollar on the deductions. And as we get into chapters when we talk about adjustments to income and the standard and itemized deductions, you'll kind of start to see that those are not dollar for dollar reductions in what we may owe in taxes. Okay. What statement is false concerning a refundable credit? Well, if we go through, a refundable credit reduces the tax liabilities to 0 or below. That's true. Allows a taxpayer to receive a refund. That's true, especially when we talk about the earned income credit, the additional child tax credit, and the American Opportunity Credit. They're refundable portions, even though those credits may wipe out our tax bill. They keep going on, and they can make us have a refund. And in the case of the earned income credit, sometimes that can be a pretty sizable refund. Letter C is cannot reduce the tax liability below 0. That is the false statement. Again, a refundable credit can go beyond the total tax liability and create a refund. Okay. Number 3, which of the following is a requirement for a qualifying child for purpose of the child tax credit. Okay, so we're going to kind of go through them. Okay, so which of the following is a requirement? You know, again, qualifying, when you hear that coming from the IRS or something is a qualifying child, a qualifying relative, qualified education expenses, chances are there may be one or more or a series of tests or questions that have to be answered yes in order for you to be eligible for it. In this case, we're looking at the child tax credit. All right. The first one is the child must be under 18 years of age. Again, that's false. Okay. They have to be under the age of 17. So 16 and younger are the ones that qualify for the child tax credit. Okay. The second one is the child must be claimed as a taxpayer's dependent. That is the true statement. That is the one that is a requirement. The child tax credit is a credit that follows the dependent. I know in a couple of the problems, and we've had discussions where I've talked about the fact that, you know, if you have a divorced couple and they're giving, you know, back and forth the claiming of the child, you know, one child may be able to claim the child. The other one may, you know, be the non-custodial parent. That custodial parent can release the child tax credit to the non-custodial parent for their return. Well, that means that that dependent goes on to the non-custodial parent's return where the child tax credit follows them, okay? So that custodial parent gives up having that dependent on their return, okay? All right, number 4, which statement is false concerning a qualifying child that allows the child to be claimed for the child tax credit? All right, so we're looking at these with the false. So which of these is false? The child lived with taxpayer more than half a year. Again, that's that test for qualifying. That meets that residency, that they lived with the taxpayer that is considered the custodial parent or residential parent, and they lived with them for more than half a year. The child is claimed as a dependent on the taxpayer's return. Again, can't stress that enough. That credit for the dependent or the child, the qualifying child, follows the child where they're at. The third one, child provided at least half their support. Well, remember, when we have a qualifying child or qualifying relative, there's a support test, and we have to provide more than half their support. So that is the false statement, okay? We had a little worksheet. I know we had one problem that we're going to go through today where you had to have somebody, there was a test to see if somebody could claim their parents on a return. Kind of went back to, I believe it was chapter 3 or 4, can't remember, where we did the support worksheet. There was one that had you do that to see if we could claim parent on family's return. Okay. All right, number 5. It says, what statement is true concerning the foreign tax credit? Okay. A little bit of a trick question here. Okay. Reduces foreign tax liabilities to 0. Okay, that is false. Okay, may allow the taxpayer to receive a refund. That is false. Okay, because basically it's telling you that foreign tax credit is non-refundable. Okay, allows the taxpayer to offset taxable income on which foreign tax was paid. That is the true statement. Okay, and I know some people might have put D for the foreign tax credit. Form 1116 is where the foreign tax credit goes, but you're not required. So that's kind of, there's 2 answers that you could have had correct here. You could have had C and you could have had D. Most of the time, that Form 1116 will be used when somebody has foreign earned income. The other day was online with a student, or excuse me, a client, and they live in England. They had moved there at the beginning of 2018. So I'm working on the return form because they are both U.S. citizens, but they went to England for work, and now they have pay over there. So they have foreign earned income. Well, they're paying tax for 2018 on that income in England. So I am able to fill out the Form 1116 for them. You do not most of the time need to do that when you see that foreign tax credit. There's at the top of it, there's a little spot where it says the kind of abbreviated or simplified, I think they call it, method for claiming it, or you can just put it right on the line. Okay. All right. All right, we have name the two education credits. Whoops, I went, oh, hold on here, get myself out of the way. The two education credits available to the taxpayer and write the phased out amounts or income amounts of each. Again, we have the American Opportunity Credit, we have the Lifetime Learning Credit, okay? What they mean by phase out, that's when the credit based on the adjusted gross income on the return, that's when that credit no longer is available to the taxpayers, whether they're single, married, filing, joint. Obviously, these are two credits where we're kind of off the table on the married filing separate. But the American Opportunity, if the joint return is $180,000 adjusted gross income or more, that credit is not available to them. It's $90,000 for single or head of household. The Lifetime Learning Credit, we get to $134,000 married filing joint and $67,000 for single or head of household. That credit disappears. So, you can see that, the credits are there to a certain point on the return, and then they all call it phase out, okay? Now, that phase out, the one thing that it does do is it starts to kind of fade. I think I brought up the picture, and I always use it. Hopefully I'm not dating myself, but you go back to Michael J. Fox, Back to the Future. You remember he had the little picture of his family, and he's trying to do all those things, and as his things are happening, when he traveled into the past, you could see his family start to fade away. That's what that credit does. So it starts to fade away at $160,000, and by $180,000, it totally disappears. Lifetime Learning Credit starts to fade away at $114,000 and totally disappears at $134,000. Obviously, it kind of, you can see on the form, it eases itself in, but, you can see that, that credit sometimes for higher income on tax returns will start to fade away. Number 7, name the education credit available only for the first 4 years of post-secondary education. That's the American Opportunity Credit. Again, first 4 years, okay? Like I said, I think I drew that last time. I put those years up. I put 5 academic years up. So in the case of somebody starting in the fall of 2019 and then the spring of 2020, that's their first academic year. When you do 4 academic years, you actually see 5 tax years. Well, that 5th tax year, you cannot take the opportunity credit. You can only take it in the first 4, okay? The maximum amount of the American Opportunity Credit is, we're at number 8, $2,500 per student. So if I have 2 students in college, I can get that American Opportunity Credit for both students, okay? The maximum amount of Lifetime Learning Credit is $2,000 per return. So even if I'm a husband and wife and we both decided to go back and get our master's and we're taking classes and we're on the Lifetime Learning Credit, we can only max out for that credit at $2,000 per return. I don't get to max out $2,000 per a person in graduate school, okay? So that's another big difference between that American Opportunity and Lifetime Learning. American Opportunity per student, Lifetime Learning per return, okay? Number 9 states that in 2018, Michael Cook paid his educational expenses at a community college where he completed his freshman year and he began his sophomore year. His father, John Cook, provides more than half the support for his son and claims him as a dependent on a tax return. Which of the following is correct? Well, based on some stuff we already talked about, you should really be thinking, okay, who paid it? All right. And now we're looking at John's father, more than half the support, independent, and has him as a dependent on his tax return. We're looking at that qualifying child, okay, or qualifying relative, but in this case, it's somebody that's on the return as a dependent. So he's meeting some tests. So that's the fact. Which of the following is correct, okay? It's B, John is eligible to take the American Opportunity Education Credit on his 2018 return. Dad gets it. Now, little nuance with this, can't remember if they covered it in the textbook, but if we bring in a third party, okay? So say we have, in this case, John Cook is the parent, has Michael Cook on his tax return as a dependent. We're gonna bring in a third party, all right? Grandpa Cook. Well, Grandpa Cook has decided that he's gonna pay tuition for the second year, since he's decided that Michael's a serious student. So here he comes along and says, I want to pay for Michael's sophomore year. So he sends the money to the community college. In that case, even though it is a third party paying it, it is considered that it is paid by Michael, who is a dependent on John's, so John still gets the credit, okay? So it's kind of bringing in a third party, all right? So that can be the case. So, you know, even if you have a tax return where not necessarily the money is paid directly from John or Michael. The other thing to remember, and I brought it up when we were talking about some of the things when I said that the 1098-T is not as accurate as it could be, is the fact that you should get that statement of student accounts. It kind of looks like a bank statement for the tuition. Shows what's billed and how it's paid. And when that's the case, when you see that there is student loans on there, that is money out of their pocket. I understand that they're going to pay it at a later date, but that is money that they were basically given, kind of that third party scenario. That student loan was given to Michael. He paid his tuition with it. That becomes qualified tuition payments that he made. Those are not considered scholarships. Scholarships and grants, they're basically the free money, no strings attached, okay? All right, next one on number 10, okay? We have Sherry filing as head of household with her son Jeff and daughter Ronnie. All are in graduate school, okay? As soon as we read that, we should be able to trigger a thought. Jeff and Ronnie are not dependents on Sherry's return, although they live with her and she pays all of their education expenses. Sherry paid $6,000 in qualified tuition for herself in January 2018 for the term starting in January 2018. She also paid $2,500 for qualified tuition expenses for Jeff and $25,000 for Ronnie. Her adjusted gross income is $52,700. Which of the following statements is correct? Okay. Well, the one that's actually correct is D. So let's kind of pick it apart. That one's saying Sherry may claim no American opportunity. Everybody's in graduate school, so we're really at the lifetime learning. Remember, American opportunity, undergraduate, first 4 years, and the $1,200 lifetime learning credit, okay? Even though she paid $2,500 for Jeff and Ronnie, they are not dependents on her return. You know, this is a credit that follows the dependent, so we have to be sure that we're aware of that, okay? Also, remember they threw in there about her adjusted gross income. What that means is she can get 20% of the credit, okay? So she paid $6,000 in qualified tuition, 20% of that, that's the $1,200 for the lifetime learning credit, okay? And again, when we're in some of the problems here shortly, we'll kind of pick those apart and we'll see how that works a little bit more so, okay? All right, so that was chapter 6, and I hope just having a little review like that going back, that'll help on there, okay? Chapter 7, we covered some more non-refundable credits. We talked about the child dependent care credit. Again, a very good credit for households. You know, it's obviously handy, but, you know, it's one of those ones that, you know, after seeing what my son and daughter-in-law pay for childcare for my grandkids, you know, all of a sudden they take it and yes, it's 2 kids. So I'm chopped down to $6,000. Then depending on where my income is, I can only take 20% of whatever I have there, you know, so if it's the 6,000 and then there's the limitations. So it's again, it's a non-refundable credit, which means we can only put it against our tax bill. It's also credit that is not a dollar for dollar. You know, some people will come in, especially the first time they're doing child or dependent care and think that they have a big credit coming because of, you know, some places, you know, some people are paying $10,000 or more for the care of their children so that they can both work. That's not the dollar for dollar we're going to have. That credit is put on that 2441, kind of, if you will, pared down a little bit through what the form does to the credit and comes down on that. Retirement savings contribution credit, again, great credit. Most of the time we see that, you know, if you have married filing joint and they're making less than $63,000, you're going to pare that down a little bit. You know, that's a good credit, could be up to $2,000, but again, there's an income limitation, $63,000 married filing joint, okay? But we see a lot of times if the two are working and they're contributing to their 401k, that D code in box 12 on their W-2, then you see that, and then you can say, okay, D, I put it in there, I check my retirement box in box 13, and then 8880 is the form for that, pops up, and we may get a credit for our contributions to our retirement. So it does two things, okay? Two things that credit does, when you can, I should say two things that contributing to retirement does. You know, first thing is it lowers that taxable income that's reported on the W-2. Second thing is, if your income's below a certain level, it will allow you to get that retirement savings contribution credit or the saver's credit, okay? We talked about the residential energy credit. Again, very good credit. You know, you can get 30%. But again, I urge people to be very conscious. We have a lot of clients that come in and say, hey, you did my tax return wrong. The guy that sold me the solar panels said that I was going to get $15,000. Well, yes, it's a non-refundable credit. I understand 30% of your cost of these new solar panels is $15,000. But because of your income and not having taxable income or a very low tax liability, you don't get to use the entire credit, okay? Some of it may roll over and carry forward, but again, you know, it could be years before somebody uses it up. So, you know, not saying anything against anybody that sells solar panels, but they're really only telling a half truth when they say that they're going to get this huge credit on their tax return. They do, but it's a non-refundable credit. So if you don't have tax liability, okay, and I've been sitting here in the office and gone through this with somebody, and they will pick up the phone and call and cancel their solar panels because all of a sudden they're realizing that they're not going to get the benefit as quickly as they thought. Yeah, they might have a $10 tax, or excuse me, a $10 electricity bill for the year, but down the road, it's going to end up probably costing them more money than they realize, okay? Adoption credit, again, very good credit, $13,810. You know, the adoption credit in there, and it does have some carry forward, okay? All right, so we're going to take a look at the quiz on Chapter 7. All right, so the quiz on Chapter 7 we have, one second here. Okay, first question we have, in order to claim the dependent care credit, which of the following forms listed below must be filed? Okay, as we just talked about, that form 2441. When we're doing our tax returns on the main info, when we're putting in dependents, there is that column that says DC above it, standing for dependent care. Some people say daycare, but dependent care is what that is. As soon as we check that, it will create a 2441 on our tree on the left or light up that form that we need to complete that, okay? Which of the following statements is false concerning the dependent care credit, okay? So let's kind of go through these. Credit must be claimed if taxpayer is searching, or excuse me, credit may be claimed if the taxpayer is searching for employment. Again, that is true, all right? Remember, there's that little clause in there, it's not only working, but searching for employment, okay? Dependent care credit is available to dependents under 13. Again, that's true. So if you're kind of keeping track of ages as we go along, here's one of our first, is that, you know, once that child is, you know, reaches the age of 13, you know, the child credit or the dependent care credit is off the table. C, monies can be paid to a non-dependent child that is 19 or older. Okay, that is true. Kind of a little one they threw in there for a trick. Remember, we talked about the fact that you cannot pay your 17-year-old daughter that you're claiming as a dependent and have that for the credit for the dependent care. You know, even though she may be watching and you're paying her to watch the younger siblings after school, that is not something that you can do, okay? So the answer is going to be D, preschool education such as nursery school is not deductible for dependent care. That is a false statement. It is deductible, okay? All right. Question 3 is what information is not used in Form 2441? Okay. To complete Part 1 correctly? Well, if remember, Part 1 from the 2441 really has to do with everything concerning the facility or the individual that's doing the child or dependent care. So that A for the care provider's name, B for the address, and C for that Social Security or EIN number. Those are all things that are in Part 1. The qualifying child's name is not. So the answer on that one is D. Okay. All right. What is true concerning the dollar limit for work-related expenses and the calculation of the child and dependent care credit? Okay. Well, really the intent of this question, as I talked about earlier, you know, the answer is B. is that the dollar limit, no matter what you spend, if you have one child, that amount is cut to $3,000. If you have 2 or more children, it stops at 6. So it's not child on return. Okay. All right. All right. And we have make sure everybody's muted there. I got some feedback going. Which of the following is false regarding the retirement savings contribution credit? Okay, that one would be C. The person who made the qualifying contribution was born after January 1st, 2018. Again, that's an age thing for that savers credit. Okay. Okay, so we're back on, let's see here, we're on number 6. Which statement is false regarding the residential energy credit? Okay. Basically this one, everything else that we talked about, the 30%, we talked about the carry forward, solar energy equipment qualifies. The answer is actually D. This is a credit that's had 9 lives in previous years and just doesn't seem like it ever wants to go away. So, but this one is D that we have. The residential energy credit is available for a new metal roof along with Energy STAR certified replacement windows and doors. It used to be the case, if you had a higher efficiency furnace, you put in good windows, you did a nice new front door, an insulated garage door, those were credits. But those died in 17 and they were not revived for 18 going forward. It always seemed like they had 9 lives. We can remember 8-10 years ago, every furnace place was advertising, hey, buy a new furnace from us and save $1,500 on your taxes. Again, true. True to an extent as long as you had at least $1,500 tax bill, because this is a non-refundable credit, but that portion of the credit's gone. We're only looking at things that relate to solar, wind turbines, and geothermal, more of that alternative higher end, if you will. Okay. All right, we have, let's see, we're on number 7. This is one of the few credits that the filing status married filing separately can claim. And that one is the child tax credit. Okay, so the child tax credit is one of the few that stays on the table. Okay, adoption credit, dependent care credit, EIC, those all disappear. But that child tax credit. So again, when we're talking about somebody that's 2 couples, maybe they're not divorced, but they are separated and doing married filing separate, you can have that they're part of their separation agreement is that, Mr. A gets to, claim the kids in the odd years and Mrs. A gets to claim them in the even years or something like that. And again, when they're on the return, that credit follows the dependent. Okay. Number 8, what is the maximum amount? Okay. For the adoption credit, or I should say adoption benefits for the credit, and that is $13,810. Again, a great credit. We talked about all the different all the different expenses that qualify. Those attorney fees, those court costs, the adoption fees, traveling if you have to travel even to another state or across the state or even to another country, and then that readoption. I have heard instances from couples that I've worked with that they are able to get the adoption done in a foreign country, but when they come back to the States, because of one reason or another, that they have to readopt, if you will, so there's more cost. And that cost would also be on there, okay? Number 9, a form that a taxpayer needs to complete to get the adoption credit, that is Form 8839, okay? Kind of buried a little bit, but, we can find that very easily in there too, okay? And the last one there, which of the following statements is false concerning the credit for the elderly and the disabled? Again, a very good credit. I wish it was more of a credit and more people qualified for it. But as we read these, we got to decide what is false. It may be available to a taxpayer age 65 or older. Again, we talk elderly, that's the age that we usually talk of, and that is true. It may be available to a taxpayer spouse younger than 65. Again, true. When we bring in the disabled, it doesn't mean that you have to, do elderly and disabled. If you're under 65 and disabled, you may be available for this. It may be available to a taxpayer who retired on disability. Again, that is true. It may not be available if both the taxpayer and spouse are age 65 and older. That is false. But again, if we remember from our chart that we had in the textbook a few pages back, there are things in order for you to qualify, your income must be below a certain level. And it's pretty low level, okay? And, you would hope that people that are 65 and older, that's not where their income is after working a long time in their life, or if they happen to have that hard luck where they end up on something with disability and not able to work and continue to save for retirement. But, it is a credit that exists, and we have to be aware of it as a non-refundable credit, okay? All right, so that covers that. Like I said, we're going to get in chapter 8 and 9 here shortly, okay? So we have that. What we're going to do is I assigned you a few problems, and we're going to talk about those. Again, I hope it's helping that I'm sending out the answers to the problems. At the end, we'll kind of have a little bit of an open session, if you will, where I'll let you pop open your mics or type in the chat or whatever you'd like to do. If you got certain ones that you're unsure of or something that I may have done in one of the problems, reviewing and things like that, that we can kind of come back and we'll pick it apart, or get a little more detail or a little more explanation with those. Okay. And like I said, I'm going to be doing the problems, and obviously I'm doing this with a share screen, and you're seeing me do the problems. But at the beginning of the chapters in the workbook, remember there are some little cheat sheets or help that will be able to do that. Before I forget, I'm going to put in the Dropbox. Let me just get one open here. Hold on one second. Okay. Okay. All right. I have not sent out the answers yet for 6 and 7. Usually I'll send them out after we've kind of reviewed some things, so I'll send those out when I send out the video and the homework assignments for today, okay? Like I said, we came up with a little form because we've had inquiries, just because of the way tax forms work now after the new tax law, that the 2018 was the first year with filing. And a lot of people, it used to be that it was pretty simple and straightforward because you could really take it, everything kind of just flowed off of the 1040. Now we have the postcard 1040, and we have these funny little schedule numbers and things like that. So we came up with a sheet here, and I know at the beginning of some of the chapters, like chapter 7 here, has this little part at the beginning where it talks about the fact that a child dependent care, it's on schedule 3, line 49, and we're going to use form 241. These we thought were great little things, but people were kind of wanting one spot. So this way, when we're doing a credit, and if you have something on there that you can maybe say that, I had foreign tax credit, okay? It's not on the 1040, but it's on that schedule, and I can put the schedule and the line number and then my form, okay? And in the case of the form, we had nothing. If I put dependent care, all right, that may show up on my schedule 3, form 2441. So it kind of gives you where to find the form within TaxWise. Kind of creates more of a little bit more of a consolidated. So I'll make sure that that gets in the Dropbox so that if anybody wants to print those out, I know I did have these with the students that came in to work with me here in the corporate office, and I was able to, as we did something, I said, okay, I'm going to write it on here. Here's the steps we just did. Then they had a reference to go back and say, okay, I'm entering this credit or this, income or this deduction or whatever it is. This is the name of it. Here's where I go to find it. You can start on the 1040 or you can start on the schedule. It says that I do this, this, and this, and with the form. Most of the time, it's going to be the case that I'll talk about hitting F9 to find out what's in there, okay? So I just wanted to kind of bring that up for everybody, all right? Okay, so let's take a look at a couple of the problems here. Okay, one we had that we did in class, I know, was the Nancy Reader one. We did that one there. We had on that. There was another one that was in here that was Jerry and Madeline Wilson. Again, that one was pretty straightforward, with as far as a couple W-2s and a daycare, okay? The one I'd like to go through, though, is the one that was, if you go to your workbook, page 712, we had Mike and Julia Turn, okay? All right. Okay, so I'm going to get it open here. As I'm opening it up, if we look at the bullet points, Mike and Julia filed a 1040A last year. Okay, they would like to file a joint return for 2018. If there's a refund, they would like it deposited. They would like it deposited into their checking account. They will send a check if they owe any taxes. Use the terms information sheet and forms below to complete their return. Neither Mike nor Julia was a full-time student in 2018, nor did either receive a distribution from retirement. Again, we just talked about that non-refundable credit, that saver's credit. So that would be something that relates to that. We talked about the refundable EIC. None was disallowed or reduced, so that will allow them to be eligible should they have a qualifying child. The family was covered by health insurance for the entire year. And then we had a little thing here where we had that they would like to claim Julia's mother, Grace, as a dependent. Grace receives a small pension of $2,400 a year, plus her Social Security of $91.92. She gives her family $400 a month toward her support. She deposits her pension into a savings account. She spent $200 at craft shows. Grace has $15,000 in her savings, so she must be winning big at bingo somewhere, and she's tucking it away. And so we're supposed to use the worksheet, and again, that's that support worksheet, to see if she qualifies as a dependent, okay? So on that one, there's not really that support worksheet that's in there, but we're going to kind of go through here. Give me 1 second. Okay, so if we go past everything, the first thing we're going to take a look at is on page 716 in your workbook. We have that support. We have that support worksheet that's for Grace, Julia's mother, to see if she can be claimed as a dependent. Okay. So on the first line, it talks about enter the total funds belonging to the person you supported, including income received and monies borrowed, plus the amount in savings and other accounts, okay? So if we take a look at that, she has her income, all right? There's pension, her Social Security, all right? And she has her savings, okay? So if we take those all, and we have the $15,000 in savings. We have her $2,400 in pension, okay? and we have 9192 in Social Security. That first line, we have 26,592. Okay, so we got 26,592 on line 1. Line 2 says enter the amount on line 1 that was used for the person's support. Well, we see from this that we had $400 a month toward her support. All right, so there we take that 400 times 12, we got the 4,800. Line 3, it says enter the amount on line 1 that was used for other purposes. Okay, well, that kind of is where we're backing out that other money. So if we think about the fact that we have 9192 from her Social Security and 2,400 from her pension, and then we're backing out that 4,800, okay, we have $6,792 that was used for other purposes, okay? So line 3 is going to be 6,792, okay? Line 4 says enter the amount in the person's savings and other accounts at the end of the year. That's that 15,000, okay? So we got the 15,000 there. Now when we add those 3 together, it should equal line 1, okay? So we had the 6,792, we had the 4,800, and we had the 15,000. Whoops, my calculator doesn't work. We get the 26,592. So line 5 and line 1 should be equal, okay? We're going to do the expenses for the entire household. Line 6, we have lodging. They paid $1,200 a month. So on 6A, we have 14,400. On line 7, we have entered the total food expenses. Obviously, they eat quite a bit in this house, but we have $300 a week spent on groceries. So we have 15,600. We have the utilities on line 8. Those are $509 a month. Okay, so we have $509 a month there. So we got $6,108 there for the utilities. Nothing on line 9 for the repairs. Expenses for the entire household. You know, we have there we have the do not include expenses of maintaining the home, such as mortgage interest, insurance, things like that. So we don't really have anything to put on there. We do not put the 1,500 on there. And enter the total number of persons. Okay, then we add up those and we enter the total number of persons who lived in the household. So we have our utilities. We have, let's see, going back through things, we have our utilities. We have our food expenses. And we have our rent. So we should be at, I believe, 36,108 if I got everything on there. Okay. And then for line 13, we're going to divide that by the number of people in the house. Okay. Yeah, I don't have the worksheet up and open on that. Okay. So if you can just make sure you have it open in your workbook. All right. So we have that. Expenses for the person you supported. We talked about the fact we have 72 on that one. We have the 7221. Okay. Her clothing. They supported 547 on the clothing, so that's line 14. We have education, no education, medical and dental expenses. We had doctor's visits and medications. So we got 1010 there. Okay. We have, let's see where we at. Medical, travel, and recreation expenses, that entertainment for the family, $1,500 per year. But remember, we divide that by the number of people in the household. So we got another 300 there. And the total of the other person's other expenses, she spends $200 at crafts. Okay. So we're going to add those all together. All right. And we should have a total of 9278. And then on the next part, it's telling us that we need to take that number and divide it by 2. All right, and we have 4639. So 4,639 is our number on line 20. And on line 21, we put the amount from line 2, which was 4,800. Okay. Then our question says, is line 21 more than line 20? Okay. It is. All right. Okay. Not by much, but it is. Line 17. Line 17 is $300. We take the $1,500 for the family divided by 5 in the household to get that $300 there. Okay. All right. So that way, that means if we answer yes, that 21 was greater at 4,800 than our 4,639, okay, then that means that we answer yes. Says you do not meet the support test for this person to be either your qualifying child or qualifying relative. Stop. So in this case, Grace is not eligible. All right. She is not eligible to be a dependent on our return. So in this case, Mike and Julia do not get to claim Grace, their mother, on the return. All right. Okay. Okay, so we're back in there. Okay, so we're going to try to bring this return up. Let me get back up here to the main info. And we have okay. All right, so we're going to go through and do this return. This is again, this is problem 7.3 in the workbook. Okay. So we'll have another return that you can see where we're doing stuff. Okay. So I have Mike U-turn. Of course, he's a truck driver. With that name, wouldn't you be a driver of some kind? U-turn. We have Julia turn. We have her social security number. All right. We have their address. They are living at 14 Grove Street. Okay. And they are in Angola. All right. We have their email. Of course, it's going to be U-turn. Why wouldn't you capitalize on that? I hope he has royalties on his name as a truck driver. Okay. We got phone numbers for them. And we have a cell phone. Oh, come on. Here we go. All right. We have their date of birth. I always tell everybody, pay attention when you put date of birth in, especially what we talk about today with retirement. We have important things that come up with that. All right, we have truck driver. We have baker. All right, we're going to have a married filing joint return. Down here for dependents, we have listed on our main info sheet, we have Daniel, Darlene, and Grace. But remember, we determined from our worksheet that Grace is not eligible. So we're going to put Daniel in there. His name, his date of birth. Okay. As soon as I see that age, my next question to Mike and Julie is going to be, is Daniel in child, or do you have both kids in child care so that you can work? And they're going to say to us, based on the little document that's on page 715 in your workbook, they're going to say yes to us. Okay. So as I'm putting things in here, all right, and that is their son, who lived with them all year long. Okay, going back to this box in the code, I talked about it a little bit earlier. Obviously, in this situation, Daniel and Darlene live with Mike and Julia, but so that is their child. But if there was the case that one of the children was from a previous marriage or, you know, some situation like that, that would be the case that, you know, they might have a child that they get to claim, but that does not live with them. So as soon as I put that on there, okay, if I put a 2 in here, you can see that the child tax credit comes up, okay? All right. Okay, so they are not living with us, but that's a child that I get to claim, but I have to do a form 8332. So this is a form that they would have to do and have to complete, okay? And that would be signed by Daniel's custodial or residential parent to release the credit to Michael and Julia, okay? But in this case, we're doing this as child who lives with them. And again, we talked about the fact that we asked them as soon as we saw they were under 13, do you have dependent care? And again, always check EIC, okay? If we look on our tree on the left, as soon as I check that DC, that dependent care column, you can see on your tree on the left that we have a little red thing that popped up over there. We got it in the red box, 2441. We know that that is our child or dependent care credit, okay? So that form will populate on that tree on the left, and we're going to say, oh, they got dependent care. I'm going to have to come back and make sure I complete that so that I can see if they're eligible for that dependent or child care credit, okay? All right, and then we'll get Darlene in there. And we have her date of birth. And again, you can see that she is under 13, so we've already asked. So we probably had a discussion there about the kids being in child or dependent care so Mike and Julia can work, all right? And they both are, okay? We're gonna e-file returns. Always make sure on this one that, you know, we got the New York in there so that we're filing a state return, all right? They talked about the fact that they want their money to go into their bank account. Okay. We have here, when we do the PIN, as I told you, it's a 5-digit. I just use their zip code. Okay. So we're kind of completing our main info. And I tell everybody in my classes, and I think I've reiterated it to you, make sure that you're always completing the main info before you do anything else, okay? Because some of the information that's on here, you know, it's used doing these forms, and we got to make sure that we have accurate information. As far as identity, just check the first 2 boxes and then the first box down here. You know, again, later problems and some of the other practice problems that I'll probably send out to you, we'll have some driver's license information, okay? And we can put in our ID number on that, okay? Just to clean up a couple things, we talked about the fact that it says in the bullet point that the entire Turn family had health coverage for all year. So we're going to go up here to our ACA worksheet. You can see it on the tree on the left. I have it in blue, but we have there that they did not get it from the marketplace. They had it all year, so they don't need any exemption. And then we just check that first box behind each of their names. It says they had it for the entire year. Okay. All right. So the first thing we're going to tackle is on page 714. We got doggy done delivery. Okay. So again, when you want to do your W-2s, some different ways to navigate to it. And again, this is kind of with that sheet. So if on that sheet that I was just showing you with the grids on there, W-2, what do I do with it? Well, it depends how you want to do it, but it is on the 1040 line 1, and I can go over and light up my box, hit F9, and I can see that I have a wage statement there, okay? I could go to add a form, all right, and up in the look for, type W-2, and again, way down here at the bottom in red on the screen, you can see it says wage, or I can go to my tree on the left, and I clicked on it, became blue, and opened up a W-2 for me. Again, however you like to do it, just so that you know where you can find the documents. Myself, I drive off the tree to find the forms, or off the schedule or the 1040. Some people like to use the add a form, okay? You know, if I'm off the tree, that I can hit F9 in that box and says, what am I supposed to be doing here, okay? So in this case, we have, this is Michael, so he is the taxpayer. We check the address to make sure that it matches what's on the W-2. We're going to put in his EIN number for his employer. All right. You can see that doggy done delivery came in. And again, type everything in all caps. So we have that. We put his income in here. He's making $24,210. We have his withholding. It's telling us to verify the withholding. We double checked it against the W-2. Looks good. All right. We have nothing in box 12. Remember, we talked about the fact that we may see a D code there for some contributions to retirement. Box 14 here, nothing we really have to do with that. We can go into the amount box, click on it, hit F3, our function key to get rid of our red. And then down here below, remember, sometimes we're doing all this stuff up here. We're looking at the W-2 and up at the top. That state sometimes sneaks up on us, okay? So we're going to go down to, hold on one second. Okay, so we're going to go down to the bottom with the state, put in that withholding, okay? So we have that in there, all right? Now, we have another W-2 to do, and this one is going to be for Julia, all right? So again, you can do the W-2 however you want to, but now that I'm on a W-2 form, if you look up here in the top, you can see where it says copy W-2. Well, all I'm going to do is hit copy W-2, gives me another blank one. I can click this one on for the spouse. It shows that it's Julia. I verify the address on the W-2. It looks good. I go in and put my employer number in there. Oops. All right. She works for Donuts Unlimited. Hope everybody got a chance to have some breakfast this morning. All right. Again, our little box comes up. We verify the withholding. Looks good there. We move down. There's nothing in boxes 12, 13, 14. When you have somebody that has dependent care, one thing I want you to always be conscious of, all right, always be conscious of is that you take a look at this box 10, okay? Because if somebody has child care, they may have an employer that gives them some money to help. And sometimes, again, kind of out of sight, out of mind, we're thinking about box 1 through 6, doing all the stuff that we're doing. And, you know, with the withholding, getting it in, stuff like that, we might see a number in there. One of the employers in the area that does this quite often is Geico, gives money to their employees so that they can have child care to work. Some of the other larger employers do that too, or through a flexible spending account as part of their benefit package. They may have something that they do with that. So always make sure you're paying close attention to that, okay? Again, going down there in that little red one, gonna get rid of that. We go down here to the bottom. We have our withholding here for New York. Okay, so we have that, and there's everything that's in there. Okay, now on page 715 in our workbook, we have Daisy Day Care Nursery. Okay, so Daisy Day Care Nursery. Remember, on the main info, when we put when we asked about Daniel and Darlene, we asked to make sure that, you know, hey, they're under 13. They have child care. We click that box, that DC box after each one of them. And here we have our 2441 populated our tree on the left. Now we can take a look at it. All right, 1A, we're going to go in there and we're going to put in our Daisy Daycare. Okay, and they are on course 123 Daisy Lane. And we're going to say they're in Tonawanda. We have an EIN number for them. We're going to put that in. All right, no dashes in there, okay. Tax amount, or excuse me, amount paid, $1,600, okay. Now, if this were to be Well, it should be Daisy. Sometimes if a database has a number in there. Okay, so we have that. Now, if this were to be a church, okay, right here, they may not have an EIN number. We could put in tax exempt, okay? That would be the EIN number that would go in there, okay? So that if we have a church or school or something that's tax exempt, they may not have an EIN number, but they are somebody that we can have record of. We just put tax exempt in there, okay? As we scroll down here, we can see we have Daniel and Darlene, and then on our statement it shows for Danny we paid $1,200, for Darlene we paid $400, okay? So there's our $1,600. So now we've completed that form, all right? Remember we talked about this being a non-refundable credit, so we go to our Schedule 3, all right? There we have it, line 49, our child independent care credit. So there's where it shows up. If we go up to our 1040 page 2, and we go down to our section where we have our credits, we can see from Schedule 3, line 55 is our total credits. There's where it shows up for us, okay? All right. So on this return, if we take a look at it, we got wages for the two of them. We didn't have any other income as far as interest or dividends. We had no other additional income come from our Schedule 1. We had their standard deduction. They did not itemize. We have their tax based on their taxable income of $25,429 on line 10. We can see here that their tax is there. We had the child independent care credit, and we had the $320 for the dependent care credit. Now, let's go back and take a look at that, okay? So, their income was such that they had that income, they got 20%, so they got $320, all right? So, hierarchy-wise on the credits, whoops, if we take a look at how things were calculated here, that credit went in there, ate up the first portion of the tax bill, then our child tax credit ate up the rest of it, but we know for the sake of the child tax credit that we have a refundable portion. So that $1,650 and that $2,350 get us to our $4,000, $2,000 per child. So we used the non-refundable credit first, then used the other non-refundable, the child tax credit, and then because that using it second has a refundable portion that will kick down and give us part of a refund. We have our earned income credit withholding, all right? So they have a federal refund of $67.55, okay? So if you have your little answer things, and again, I'll send this out, but your little answer sheet that's in the back of your syllabus, you can write that on there. Their state refund is $740. If we look at the state, they have their child tax credit there for, or the Empire credit they call, another $320 for their dependent care, some earned income credit, and a withholding. So that leaves them a $740 credit on the state side. Okay. All right. So that gets us through that problem on chapter 7. Okay. 7.5 was a problem that was pretty straightforward. A young gentleman by the name of Greg Fellows, a single father, head of household. You know, he wanted to do his refund electronically, no EIC. He is the custodial parent of Greg Jr. The one bullet point that was on there was Greg replaced his furnace at a cost of $27.35. Now, if this would have been a return done 2017 and prior, we would have had a energy credit. But in this case, it died at the end of 17. It's not a solar, it's not a geothermal, it's not a wind turbine, so we do not have a credit for that, okay? In the health insurance, they were covered all year long, all right? And again, just a W-2, and with the fact that Greg Jr., we ask, he's under the age of 13. They had from a wilderness daycare, he had a child care credit there, earned income credit, so, you know, pretty good one there, that pretty straightforward on that. Okay. All right. Give me 1 second here. All right. Okay, as far as the screen here, we have a few things to clean up on here. If you look on my tree on the left, I got some red exclamation points. You just clean up, re-enter the routing number for his deposit. He wanted it to go into checking for the turns. Our EI worksheet, we answer our questions on this one. The first question says, does the taxpayer and spouse have a social security number? They do. Was the taxpayer a resident of the United States? Yes. Excuse me, a non-resident alien of the United States? No. We didn't have any investment income greater than $3,500. We talked about that one. And the qualifying child, could they be of another person? No. And then down below here, we have to make sure that Daniel and Darlene are unmarried. They lived with the taxpayer for more than half the year, and that there is nobody else that's going to be able to claim them. Okay. And then down here below, it says, does the qualifying child have a social security number? Yes, they both did. Remember, we said from our bullet point that no EIC was disallowed or reduced in the previous year. Okay, so that cleans up our due diligence there. Okay, we have again question asking about EIC, or excuse me, child tax credit. It was not disallowed. Okay. And then we have our due diligence, prepares due diligence, read those questions and answer those on the 8867. We'd have to clean up a little bit here on the state, the school district or resident school district, the school district number. Did they have foreign accounts? No. And in this case, there was no deferred comp on the return. All right. And then on the last page, we talked a little bit there about the refund, but down below, we're going to put it into the same bank account that we do in the federal, and it's a personal account and direct deposit. It's not going to the Cayman Islands or Switzerland or any other foreign country. And then the last thing we clean up on there is our heat number that you'll get later from New York State. Okay. All right. So that is that return. Again, I will send out the answers. If anybody wants PDFs of any returns that we do, because they want to see the forms and the numbers that appear on the forms, you have to let me know. I'll create PDFs and put those into the Dropbox for you. Okay. All right. Okay. What we're going to do now is we're at, let's see, we're at 10:20. So we're going to take 10 minutes to 10:30. We'll go through chapters 8 and 9. Again, seems like there's a lot in there. It's not too bad. We got some state considerations and things to do, but we'll go through those, come back to a couple problems after we go through that, and then we can wrap it up for the day. Okay. All right. All right. So we'll see everybody back here at 10:30. Go and warm your coffee up. If your house is being heated by your fireplace, put a couple logs on, and then we'll see everybody back here. All right. Welcome back, everybody. So we just got done with chapter 6 and 7, doing some of the quiz. We're looking at some of the workbook problems besides the ones that we had done. So we're going to get into our chapter 8, which is our capital gains. Then we'll be working on chapter 9, which we'll begin to talk about some of the retirement income and how we handle those. Okay. All right. So chapter 8. Let's see here. Let's get that up in front of us. Okay. All right. So chapter 8, we're going to start talking about capital gains. Now, I realized this chapter, there was a lot to digest. as far as everything in there, throwing out a lot of terms. It sounded very investment and very confusing, and seemed like there were a lot of things that that you're not realizing as part of taxes. There's a lot of content in this chapter. What I'm going to do is boil it down to the simplest that I can do. Really, the capital gains that we will deal with 95% of the time have to do with the buying and selling of stock or bonds or whatever investments. The other capital gains that we deal with 95% of the time is something that has to do with the sale of a home, whether it be an inherited home that we get from mom and or dad or somebody else, or our personal residence or a second residence or whatever that may be. Okay? So boiling it down pretty simple, and I do it every time with everybody, is that we start out, we have a basis. Okay? The basis, that is the cost. That is the value of something that we took ownership of. Okay? So in the case of capital gains, they talk about basis. We'll talk about the different types of basis, but it is the cost. Okay? And then we typically either sell it for a profit or we sell it for a loss. And the differences between the loss, where my basis is in this, and the basis and what we sell for is a gain, that is our capital gains. All right? That's what we pay tax on. All right? So we got to be able, and the most important thing about capital gains is making sure that you have an accurate amount to hang your hat on that says this is what the value, the fair market value, the cost, the basis, whatever you want to call it, that is what I own. When I took ownership, that is its value. So we got to make sure that we determine that. Okay? The other thing that we have when we talk about capital gains is we have how long did we have that? From the time that we took ownership, how long before we, they usually call disposed of it, but how long before we sold it or no longer was being owned by us. So we have to determine short-term, long-term. As it says here, holding period of 1 year or less is deemed short-term. Holding period of more than 1 year is long-term. Okay? So we've got our cost basis. Did we sell it for a profit? Did we sell it for a loss? Can we take the loss? And then how long did we hold on to it? Okay? So that's really what we're going to talk about. Okay? As you see down here with the objectives, we got to determine the basis of the property, a capital asset, again, fair market, all that is something that we owned. What is it, the value of it? Okay? We're going to determine the tax consequences of selling or trading the investment property. Okay? We're going to talk about capital gain or loss when we sell our home. All right? And then how do we report all this on the tax return? Okay? Now, at the top of page 8.4, we go in there and it talks about all these different publications that we have. All of them are very good as far as giving you information. Again, some of the information is such that, they're very rare. It's good reference, but I just want to cover the main points that deal with capital gains. So we have our cost basis. And again, cost basis is just, what do we pay for the item? Either in cash or we took a loan out to pay for it or whatever it may be. What was that value? Okay. So, if it's a stock, what do we pay for it? If it's a stock that we inherited, what was the value when the person that passed left it to us? That's our basis. Okay. If it's a home, what was the value of the home when we bought it? Okay. If we inherited a house, again, when we inherit the house, what was the value when whoever we inherited from? What was the value when they passed? All right. There's a bunch of different scenarios you can get into with the house, with inheritance, whether the person you're inheriting the house from is passed or not. We're not going to get into that. Gets a little bit too involved, but we're basically looking at a cost basis. What is the value of that item, that capital asset, or whatever it may be, that when we took ownership and it became ours? Okay. You can have adjusted basis. You have where you can adjust the basis based on things that happen. We're going to talk about a chart. And then we have something down here where we have a basis other than cost. basically that's saying that the cost cannot be used as the basis. In this case, fair market or the adjusted basis may be used. Most of the time we can chase it down. You know, if you have a home, chances are you can probably go to the assessor or something, and somewhere along the line there's something that would be where there's an appraised or fair market value of that house, something on the roll. In the case of stock, you can always go back and chase it down. If you want to write this down, there's a great website called Big Charts, bigcharts.com. It's a website that is very good to look up, you know, various stock values. All right. But if you Google Big Charts, all one word, it's a website, and you can get in there and get historical quotes on various stocks. You know, if it's, you know, going back to the first day they sold Apple, you know, if you want to look it up. And so you can do that, and it'll give you the stock. So if it's a case that somebody has a stock that they don't know what the value was when they took ownership, or when somebody passed, they're not sure of it, and it's not reported on any documents that they receive, the 1099-Bs that we talk about, you know, that's where we can look that up. Okay, so that's Big Charts. So there's always a way to find something with the basis other than cost. Okay. At the top of 8.6, we were talking about the adjusted basis. Here's ways that the basis is increased or decreased. Okay, great little reference chart here. You know, you can see capital improvements. Maybe the town put in a new water connection or sidewalks or redid the roads. Okay. We have a decrease to the basis. Maybe something happened with, you know, that there was insurance loss. You know, maybe we had some depreciation. If this was a rental, you know, again, we'll get into more of that when we get to the Schedule E talking about rental income. Okay. Do cross off down here at the bottom. I'm not sure how it ended up in there, but there is no decrease in basis that have anything to do with adoption tax benefits. Okay. Please cross that out. Okay. All right. Okay. Exchanges, again, we're not going to talk a lot about this. You know, when we have property that, you know, that we receive in an exchange for another piece of property, then, you know, if I trade one thing for another thing, then I have an adjusted basis that's based off what I received in exchange for it. You know, it gets pretty involved in that. You know, most of the time when we see this, it talks in here about the 1031 exchange, as far as the up to my page here. That's interesting. Where did the rest of the pages go? Okay, give me 1 second here. We seem to. Okay. All right, give me 1 second here. Let's see if I can find out where the rest of the page went. Hmm. Okay, there we go. We found it. All right. That was strange. Okay, so we have on here that we were talking about the exchange. The one that you're going to see most often on this is when we talk about rental properties. We'll talk about a 1031 exchange where somebody can sell one investment property, do what's called a 1031 exchange, buy another property, and not have to pay capital gains on the sale of that investment property. But we'll get that when we get to our Schedule E. Okay. As it says here, fair market value is the price at which the property would change hands between a willing buyer and a willing seller, neither of which is required to sell or buy, both of whom have a reasonable knowledge of all necessary facts. So, if I'm selling you a Babe Ruth baseball card, okay, that is we have to determine the value of that. And really, the determining the value of that is, what is the value between a willing buyer and a willing seller? That's what's going to turn the market value of that card. It doesn't necessarily have a price tag on it. It's just that's what the value would be should they want to make a transaction. That is our fair market value. Okay. All right. Have some exercises in here. Okay. Again, sale of investment property. We're not going to get into it too much. There's information here about it. I want to cover it more so when we are on Schedule E's and rental income, so that makes a little bit more sense there, but at least it gives you some knowledge as far as the capital gains. Okay. Sale of stocks and bonds. Okay. We use this 1099B is what everything for the proceeds from the sale from brokers and things like that, where they buy and sell stock. You're going to see the 1099B that we use in the workbook. You'll see it here in the textbook. Unfortunately, it is probably one of the least used forms by everybody but the IRS when it shows what a 1099B is. So it's very good for us to use in instruction, but it is really not what everybody's going to see. So inside, let me get it 1 second here. Okay. All right. So everybody see that okay? And we have it, and I realize it's sideways. This is inside the Dropbox that I've given everybody a link to. There's an example of a K1 I told you. When we were talking about interest and dividends, we took a look at the dividend statement that shows up on this investment. In this case, with capital gains, and we have where we're looking at the bottom here, there is a sheet that talks short-term, long-term, or capital gains. You see the 8949, okay? But our stock transactions, if you look if you have the paper, it's the top left. On the screen, it's the bottom left, but it says 1099B. Okay, so you can see this is how we're going to see our investments and our brokerage accounts come to us when we're doing tax returns. Okay, well, you won't see them that often where you see them like this. We'll see them that other direction, but we're going to use this for the sake of our instruction. Okay, we have in there that the description. So if it's, as it says here, 100 shares of XYZ company, when we acquired it, when it became ours, when we sold it or disposed of it, proceeds, what did we sell it for in box 1D, 1E, cost or other basis. We talked about our cost or adjusted basis or other basis, so we can see on that. So we have that in there. And then there's box 2 that talks about, was it a short-term or long-term? Well, we should be able to determine that from our date acquired versus our date sold. Year or less, short-term, year or long, year or longer, long-term, okay? All right. We talk about our gain and loss. And again, we're not going to get too hung up on some of this, okay? Sale of personal residence, okay? Now, a lot of people have this sense that the sale of their personal residence, that the gain is a one-time get-out-of-jail-free card, that you can sell your main home, your personal residence once, make money, and not pay tax on it. That is not true, okay? You can pay, you know, there's that you can take and be excluded from paying capital gains on your residence for a couple reasons. First one is that if a taxpayer's main home was sold in 2018, okay, they may be able to exclude from income any gain up to a limit of 250,000 single, 500,000 joint. What that means, if I am married filing joint, and I paid $500,000 for a house, and I turn around and sold it for $1 million, that $500,000 is not a taxable gain. Now, if I sell that house for $1.1 million, so I bought it for $500,000, I sell it for $1.1 million, that means I have a $600,000 gain, okay? The first $500,000 is excluded, so I only have to worry about capital gains on $100,000, okay? All right. Now, this exclusion two, the stipulation is that you must have lived in it for at least two full years in the last 5, okay? So this is sometimes where you see people not really flipping houses, but they buy a house, fix it up for, live in it for 2 or 3 years, and then find another one, sell that one, and buy a new one, okay? They don't pay capital gains, all right? Now, if it's somebody that's flipping houses, that means they're not living in it. It's not their personal residence. They don't live in it as their main home. Then in that case, then they're paying tax on that, okay? So no matter if they live there, you know, or owned it for 2 years, if it was not their main home or their personal residence, then they're paying tax. That's what would be a flipper. You hear about people flipping houses, okay? 1099-S is the form that's used for these transactions. Just because there's a 1099-S issued with a income amount on it doesn't necessarily mean that there is a taxable gain on it. It's just saying that, you know, this transaction was reported to the IRS. Most of the time we don't see 1099-S's. If we have to determine something with capital gains, the best way to do it is get a copy of that closing statement. You know, that HUD-1 sometimes it's called, where it shows the, you know, the sale and the seller and the buyer and what happened and transpired between the two of them, you know, concessions, you know, realtor fees, things like that, okay? Main home, again, not just a house, houseboat, mobile home, co-op apartment, condominium, those are all there, okay? Here's that excluding the gain. The taxpayer to exclude the gain must have owned and lived in the property as their main home for at least 2 years during the 5-year period ending on the date of sale. Okay, so when I sell that, I go back 5 years to the day, and if I can show that I lived in there 2 or more years, 2 full or more years, okay, doesn't have to be in order. All right, it's not like it has to be 2 years or a year back to back, adding up to 2 years, but I can show that it was my primary residence where I owned and lived in it for those 2 years. I can exclude 250,000 as a single person, 500,000 as married filing joint. Okay. As far as determining that, you know, the IRS really does look at this pretty hard. Okay. They're going to look at things when you're trying to say, oh yeah, that was my main residence, so I'm excluding it. Is that where your mail's going? Are you registered to vote where that house was? Okay. They're going to look and see where your federal and state tax returns, what address do they have on it? Where's your refund being mailed? What's your driver's license and your car registration show? Where are they working? Where's their bank? All right. Where's their relatives? Where are they going to church and playing golf? You know, they're going to look at all of these things. And if you're trying to exclude income from the sale of a residence as your primary, you better be able to say, yep, this is where I lived, and I lived there at least 2 of the last 5 years. Okay. Now, because we get to do an exclusion, okay, whoops, you get to do an exclusion on the gain, we cannot, as it says here in the help box, a loss on sale of a personal residence may not be deducted. So if we're just trying to get out of a house and we got a loss and it's our personal residence, we can't take the loss. And basically IRS's position on this is the fact that we're excluding that $250,000 or $500,000 gain. We're not going to let people take losses. Okay. When you sell the house, you know, we talk about expenses that you can include or add to your basis, commissions, advertising, legal fees, loan charges paid by the seller. So again, 1099-S, you don't see those issued, you know, often, maybe half the time. The attorney that does the closing will issue that, but that HUD-1 or that closing statement is much better to be able to determine, you know, what the basis is for that. Okay, and we'll be talking about the main home and such when we get into the forms. All right, reporting losses and gains, we're going to do them on a Schedule D. Okay. We're going to use the Schedule D where all the capital gains, the different things that happen with it. We're going to talk about it in a second when we do a problem, or when we do problems today a little bit later. So we'll come back to that. You know, they're on there. The supporting form for the Schedule D is our Form 8949. That is a form that there's an 8949 each for each of the different short-term, long-term, whether the IRS is aware of the basis or not aware of the basis or even aware of the transaction. So, but we'll see that when we get into the forms and the returns, okay? Let's see here, 8949s, and a lot of this stuff as far as reporting the way things were done on the 1099-Bs kind of stem back to 2008 when the stock market took the hit that it did, and a lot of people lost money because everybody was trying to figure out how much of a loss they had. And a lot of these losses were undeterminable because the brokerage houses weren't keeping good basis. So, you know, some of the stuff is from 2008 where the market took that hit, so that the brokerage houses are now required to report a lot more, and then that requires you to report more on your taxes, okay? That's where the 8949 really came into play. As far as the Schedule D, okay, that's where capital gains and losses are reported. You can see Part 1 and Part 2. Part 1 is short-term. Part 2 is long-term. Most of what we're going to deal with is 1099-Bs, 8949s. We'll see that. And then down at the bottom where it says short-term capital loss carryovers or long-term, we'll deal with that. Some of these other things we really don't see that often. We might see a 6252. What that is if I'm a landlord and I've decided to sell my rental to my tenant, and I'm taking it as an installment agreement, that I might do it that way. Okay. All right. And has a little stuff about the Schedule D and some of the things there. Okay. As far as a capital loss, we can take, and if I bought stock for $10,000 and it just was awful, the company was not any good, the stock's value dropped to $1,000, I sell it, I have a $9,000 loss, okay? I can put that $9,000 loss on my Schedule D as a loss for the stock, but as far as what carries to the 1040, okay, I can only take $3,000 a year. So in that first year, I get $3,000 loss against my gross income to calculate taxable. And then I would then carry forward $6,000 to next year. Then I could use $3,000 there, carry $3,000 to the following year. So as you can see, I can only take $3,000 a year. So in this case, I lost $9,000. I only get $3,000 for the next 3 years to use. I can't use any more than that. However, if I have that $6,000 loss carrying to next year and I have a $10,000 gain, I can use all $6,000 against the $10,000 to have a $4,000 gain that I pay tax on. So we can use more than $3,000 against gains in a year, but we can only take $3,000 losses against our gross income, okay? All right, so that's really where that one comes into play. Little bracket here about, or excuse me, a little table here about your capital gains rate. Shows what the tax returns and how your capital gains. A lot of times what happens if somebody has qualified dividends or capital gains, there's a different tax worksheet that their tax is calculated differently than you would see with putting it into the table or using a formula. So they use a little bit of a different tax calculation. And a lot of times it's beneficial to the taxpayer that it'll lower their taxable income. I got some exercises here where, and again, we'll see this when we get into the problems where we're talking about getting information off 1099-Bs onto 8949s and onto eventually the Schedule D. Okay. All right. Okay, so that gets us through Chapter 8. And Chapter 9 is blank just like the other one was. So let me go get that. Give me 1 second. Okay. Okay, so we're going to go through Chapter 9. All right, so we're into Chapter 9. Chapter 9 is going to talk about retirement plans, pension, annuities, and Social Securities. Again, a lot of information in this in this chapter. Okay. Going to try to boil it down as simple as I can, hit the main points, but we'll kind of talk about various things that go on here. Okay. All right. So in this chapter, as I said, we're going to be talking about, retirements, things that you hear, pensions, annuities, 401ks, 403bs, 457s. I mean, IRAs, Roths, Simples, railroad retirement, Social Security. These are all things that we tend to think of that we have when we draw on our retirement, all right? So we want to make sure that when we talk about these, that we understand, how we put them on the tax return. And then we always hear that retirements are qualified plans or some are non-qualified. And we'll talk about that. Remember, a lot of times when we talk about qualified or non-qualified, when we hear the IRS say that, we're talking about something that's probably going to meet some tests, okay? So as you see there, we're going to talk about pensions, annuities, IRAs, and other retirement plans, how those are handled, what is taxable, what is non-taxable of Social Security, talk about the taxable portion of distributions from IRAs, talk about rollovers. Sometimes people, get money from a previous job or 401k or pension plan and they don't want to take it. They'll roll it into another account that they have, okay? All right. The term qualified, okay, is used to describe both retirement plans and other investments. From a non-technical standpoint, I guess we're getting ready for something that maybe is easy. Qualified plan investments is one funded with pre-tax dollars, okay? So really that's what it is. When we have qualified plans, as it goes on to say there, they are tax deferred. So those are tax dollars that basically we are pre-tax dollars. What that means is we're lowering our income, our taxable income, by an amount so that they're qualified. Okay, so it lowers our tax in the year that we're contributing, but in the year that we take the distribution, they will be taxed. Thus the term tax deferred. Okay. Now, one thing that does come into play with this is that when you reach 70.5 on these qualified accounts, you have to take money out. You are required in the year that you turn 70.5 to start taking what's called a required minimum distributions. You'll hear me use the letters RMD, okay? So if somebody reaches in the year they reach 70.5, they'll have to take money out of their retirement account, okay? On the flip side, if I am under the age of 59.5, I would pay a penalty for taking money out, okay? So if I take money out of a qualified account prior to turning 59.5, then that money would not only be taxable income, but there would also be a 10% early withdrawal penalty for taking money out, okay? Non-qualified And again, from a non-technical standpoint, is plan investment is generally one funded with after-tax dollars. Most often, you hear about is a Roth, okay? Because a Roth, the money's taxed on the way in, tax-free on the way out, non-qualified, okay? Now, most all of what we get, pensions, annuities, 401ks, when we take distributions or we do a rollover or some type of transaction that has to do with our retirement plan, we're going to get it on a 1099-R, R for retirement, okay? So you're going to see a 1099-R there that's going to talk about all the different things that could happen to that money. And we'll, again, when we get into the doing a return, we'll do that. There is the case sometimes, as it shows on page 9.8, where we have some that there is no, the taxable amount is not determined. We'll see this sometimes for government pensions. And there's a simplified method that I'll show you how to use when we do one of the problems that allows us to calculate the taxable portion on that, okay? You'll be able to do there with the exercise. I encourage you to go through, see how they did the calculation on that, how they determined, you know, which table to use there, you know, with as far as the, you know, for a calculation on that. But we'll show that again on the when we get into the problems. Okay. Some of the things we talked about, we see here. You know, again, it's getting into pretty involved terminology as far as investment and retirement. But we just have to make sure we know, you know, how much was taxable in the year, you know, where it came from. Were they 59.5? Are they 70.5? You know, is it a rollover? Is it a lump sum? Different things like that. So, okay. Let's see, there's the rollover. Again, we'll talk about some of this when we get into the problems that we're going to do. Okay. As far as rollovers, sometimes people are not aware there's a couple options. You can do a direct rollover, which is usually called a trustee to trustee. I roll it from my 401k into my IRA, apples to apples, okay? Or if it's the case that my previous employer, I got $3,000 sitting in a 401k, sends me a check, okay? Then in that, I was like, no, I didn't want that money. I don't want to pay tax on it. Then I can take and roll it into a IRA if I do it within 60 days, okay? So that's the way that you can have it treated as a rollover, even though they may have given you a distribution. But you have to have documentation on that that shows that money came from one, and this is the source, and it was put into the other. None of it stayed in your pocket, okay? All right. Most of the time, as it says there, when there's things that are distributions, a lot of times they'll require that they withhold 20%. All right. The other thing that's very important that I will make note on this is survivors and beneficiaries. If you know of somebody that has a 401k or an IRA and they have not put a beneficiary on that should they pass, and it is something that could go to a survivor or beneficiary, make sure that they do, okay? It is the case that if a 401k is, somebody has it, they pass and there's no beneficiaries, then obviously it goes into probate and into the estate, okay? If that money is not given to beneficiaries of the estate timely, it can be taxed inside the estate at 38%, as opposed to if it goes to the beneficiary, it might only be 12%. So again, if you got mom, dad, somebody you know, or you're an executor, administrator of a will or an estate or whatever it may be, make sure that they have all of their beneficiaries listed on anything so that there's no chance that it'll end up inside the estate and taxed at 38%. Okay, just kind of a heads up for everybody. Okay, all right. Let's see, IRAs. Again, a traditional IRA, pre-tax dollar, qualified. Okay, it's deemed to be an IRA when we see all the different things that are there for that. Okay, when we take money out, it's taxable. All right. Roth IRAs, contributions are not deductible on the tax return. When we do adjustments to income, we'll talk about things where we contribute money to retirement accounts and some that help us. In this case, Roths would not. That's because the tax deferred is the fact that they are non-taxable when you take money out. So you're putting already taxed dollars into a Roth. Now, if I take and I make a conversion, some people will do a conversion where they take and say, you know what, I want to switch my traditional IRA to Roth. Well, what happens on that is that you have pre-tax dollars that are going from a traditional, okay, into a taxed or non-qualified. So you have to pay tax on all of those dollars, all right? It's as if you took a distribution, but you're not really keeping in the money, it's going into a Roth. So it's not a rollover where you do not pay tax on it. That would be considered a conversion, not a rollover, okay? As it talks here, there's some 10% penalties that qualify for different things. Very good chart here that the differences between a Roth and a designated Roth that are good to know on there, okay? Sometimes it's, you know, some of the designated Roths that you might have from an employer, you can see that $18,500, much higher contribution limit than if you opened a Roth, personal Roth at a bank in your name, and you could only contribute up to 55 or an extra 6,500 if you're 50 and older. If you look in this one, if it's a designated Roth, maybe from an employer that's offering it, you can contribute a lot more. That's where it's becoming a payroll deduction. It's coming off of your paycheck. Okay. When I was talking about rollovers and apples to apples, great little chart here. Whoops. Okay. You can kind of see. So I got somebody that says to me, hey, I'm taking my Roth IRA and I'm going to put it, okay, and this is the following chart indicates the rollers that are permitted between various types of plans. If I do a Roth rollover to a traditional, can't do that, okay? All right. This one says I am going from a traditional to a Roth. It says yes, all right. Then I got a little footnote down here, number 3, it says must include an income. Again, that is a conversion. We're converting from a traditional to a Roth, so that is taxed as far as the money going in there. I don't keep any of it. It's a rollover, but I have to pay tax on those dollars since I'm putting them into a different, a non-qualified account versus a qualified. Okay. Let's see. I talked about survivor beneficiaries. Here's our 1099-R that we talked about earlier. Again, we're going to see a lot of this when we get into the problems. But, you know, we have in box 1 up here at the top, we have our gross distribution. We have a taxable amount. Sometimes we'll have, 1 second here. Okay. Up here, we typically have our boxes filled in there. Okay. So that we have our gross distribution and taxable amount. Again, sometimes those numbers do not match because, you know, there may have been some of the money that was in there that was taxed. We'll see that sometimes with annuities. Okay. So we have that. Let's see here. We have down here below, we have where we might see a taxable amount not determined. So 2A would be blank. Again, when we'll talk about the simplified method on in the software, we'll talk about that. We have total distributions. Okay, that would times we see that if somebody is taking it as a lump sum or a rollover or a death benefit. We'll see some of the tax withheld. Again, I talked about most of the time you'll see 20% automatically withheld, but sometimes they'll have the option not to withhold anything. Box 7, we have here, this is where it really drives the tax liability, okay? So this really drives the tax liability as to what code is in there. If it's code 1, early distribution, 10% penalty applies. Box 2, or excuse me, code 2, early distribution, but maybe it's because they were allowed to do that because they're disabled, so no 10%, okay? Code 7, all right, in 7 there. That means that they are 59 and a half, it's a normal distribution. Might put a 4 in there, it's a death benefit, okay? So, you know, that code is really gonna drive what we do with it, all right? Okay. We have Again, these are all things. We're going to talk more about that box. You see all those letters that are there. We'll talk more about those when we work on some of the problems. All right. Okay. All right. Social Security, 1099. All right. We have 1099. The SSA 1099 is our Social Security that we get. And then we have a form that is the Railroad 1099 Blue. Okay. All right. Now, the way I want you to remember this, and I'm sure you're reading through this and you read through and go, oh, wait a second, what's this railroad thing? And how come they got these two? And how do I know which goes where? An SSA 1099, it has pink boxes. All right. RRB 1099 is a blue form. Okay. Which means everything on it is blue. So SSA 1099 pink, RRB 1099 blue. Those two are always treated the same. So a way I want you to remember that is pink and blue, boys and girls together. Okay? So you got pink for girls, blue for boys, pink and blue, boys and girls together. Okay? So that's the way we're going to keep those together. All right? Those on there were determined that we're showing our benefits. The 1099 that's here. This box that is kind of gray, box 5 here, that is your pink box, okay? Pink and blue, boys and girls together. So our SSA 1099, our Social Security benefit statement there, we're going to have that as a pink box there, all right? That is the box that we will report on the tax return. Not the benefits paid in 2018, not the benefits repaid and subtracting that. We're going to do net benefits for 2018. Now, sometimes when somebody goes on Social Security disability, they might get a lump sum for prior years, and we handle that differently. It's called a lump sum election, and get pretty involved. But most of the time when somebody has Social Security, we're going to put that box. Now, over here in box 3, they'll give some descriptions of what makes up box 5. Okay, or excuse me, box 3. In there, we would have things that would say, okay, their benefits are this. They have their Part B for Medicare taken out, and they're paying their Advantage Plan premiums out of there, and that's where it shows down the net, okay? So, however, they're still going to pay tax on the gross if it is taxable. Social Security, up to 85% of it can be taxable, okay? And then obviously in box 6, if they want tax withheld, some people will elect to have Social Security have their tax withheld, all right? Okay? Again, blue form, very similar to our pink one, pink and blue, boys and girls together. So what that means is we're going to report them in the same spot on the tax return. And we'll see that when we get into the return. All right. Okay. Now we have a little chart here that's pretty good. There's an even better one on the back of a Social Security statement, but this one is figuring if your Social Security is taxable. Okay, so again, as it shows there, enter all the amount from box 5, forms SSA 1099. Great little form here to have in your arsenal, if you will, to be able to calculate how much of the Social Security is taxable. Up to 85% can be taxable. Okay. Now, the other part of the railroad is the RRB 1099R. It is a green form. Okay. So I had my other one, pink and blue, boys and girls together. Okay. This one's green. So that's show me the money. All right. What I mean by that, 1099R. Show me the money. So the R and the 1099R from the railroads, same place. Show me the money together. All right. Pink and blue, boys and girls together. All right. 1099Rs, show me the money together. So they're going to be reported on the tax return the same way. Okay. Again, it's going to look very similar to what I see from my 1099R that we looked at earlier, but we're going to handle them a little bit differently. Okay. All right. Not going to worry about civil service. All right, so that gets us through the retirement. So the best way to talk about the rest of these is we are going to take a look at some of these on a more practical where we're doing some returns and things like that. Okay, so I have 1120. What we're going to do is come back. We're going to do 2 problems, one from 8, one from 9. And like I said, I'll be able to talk a little bit more about this. So again, I got 11:21 on my computer clock here. So 11:30 we'll come back and we'll go through 2 problems for you and get a little bit more in depth in there. So we'll see everybody in about 8 or 9 minutes. All right, everybody. Sorry about that. I was getting my tax-wise up and ready to go. And we have it on there. Okay. All right. So what we're going to do is we're going to do a couple problems. And what I've decided to do, I'm not going to do any problems out of Chapter 8 at this time. I'm going to do a couple out of Chapter 9 so I can hit both some retirement, some railroad, or not railroad. I'm going to let you try to figure that one out on your own because there's one problem there in Chapter 9. But there's a couple in mine that have both the retirement income, Social Security income, and some stock transactions so that we can do those, okay? So if everybody would go to, let's see here, page 9.5 in their workbook, okay? It's class problem 9-1, so 9.5 in your book. Again, the beginning of each chapter in the workbook does have those instructions for you so that you can take a look and see what you need to do there, okay? As far as how the software works, but we're going to go through those. All right, so but we're going to do problem 9.1 on our bullet points here. Let me get my tax-wise up here, and then we'll go through. All right, so we got my tax-wise up here. All right, so we have on this, we are going to have Elmer and Elizabeth Jones. It says here, Elmer and Elizabeth filed a 1040A last year. You know, again, 1040As and EZs have disappeared. We just have 1040s now. But in this case, since we're doing an 18 return, in 17, the 1040A, that means that they did not itemize. They take the standard deduction. If they get a refund, they'd like it to go into their checking account. If they owe, they'll just send them a check. Again, so that there's no penalty and interest, that check has to be postmarked by the 15th of April. Use the main information sheet, and they had health care the entire year. Okay, so we're going to go in here to our problem. On the next page, we have the information for Elmer and Elizabeth. All right. So we're going to put in their social here. Okay, hold on one second here. I'm going to reopen my the team was being a little finicky here. All right, let's see if we can get it to come back open here. Okay. There we go. All right, so we're going to go in there and do Elmer and Elizabeth. Okay. Yep, I guess I got to change the social a little bit. All right, so we're into our return here, okay? So we have, all right. So we have Elmer, his middle initial is O, we have Jones, and we have Elizabeth, no middle initial for her, Jones, and we have her social. They are living on 65 River Oaks Drive, and that is on Grand Island. They do have an email in their iCloud. Okay, we have a phone numbers for them. Okay, and we have a cell phone number for them. All right, okay. We have date of birth. All right, and again, I talked about the fact that when I'm putting date of birth in, even if it's a carry forward from a previous client or a new client, as soon as I see that date of birth of 67, hey, they're over 59 and a half. Probably going to be all right on retirement. And they will have this one that I have to say, so let's see, she was not 59 and a half, so we have to be careful on distributions from her. 67 right now is beyond for anybody born prior to 1955. Anybody that's 66 and older has reached full retirement age, so chances are they are taking their Social Security. So that would be something we would ask about for them. Okay. We have somebody that's retired and a clerk. Oops, not a clerk, but a clerk. Okay. They're doing a married filing joint return. All right. We have no dependents on the return. They lived in New York the entire year. They are not snowbirds living in Florida. They talked about the fact that they would like their refund put into their checking account that is listed on the main information sheet that we have on that. Okay. And again, I just use their zip code from their address for the PIN number there. It just has to be 5 digits. You can always just use theirs, and that is their electronic signature. At the end of the return, before they file, or before I should say it's electronically filed, we'll have them sign a piece of paper. But for right now, just putting that PIN number in there is what they have on that. Okay. All right. Okay, so we have everything in there on our main information sheet. Okay, so what we're going to start to take a look at, we knew from their bullet points there, nothing really that we had to worry about on the bullet. The first thing we have, though, like it said, Elizabeth was working. So again, I use my tree on the left, but I'm going to create a W-2. Elizabeth is the spouse on the return. We check the address, looks good. We're going to put in her employer's EIN number. She works at Nutty for You. Okay, we have her retirement, her income and her withholding. Down here, you can usually type over or hit F3, get rid of that. On the next line, she had New York State disability from box 14. All right. Nothing in 12, so she didn't participate in a retirement plan. And then we had $500 in withholding that she had for state withholding on her income. Okay. So that was the first document on the top of 9-7 in the workbook. All right. Now, the next thing we have is that Elmer is retired. Okay. So we have some pension income. All right. We are going to go up to our 1040, page 2, our main 1040. And we see on here, this section are these lines on 4. All right. All the different things that we have that can be different amounts and stuff. But our total, we're always going to go over here to our right box. Nothing there. Okay. All right. So we have a pension. So we're going to go, and this is says that it's a pension. So we're going to go there, light up the box, hit F9. There is our 1099R. So we're able to use a document that'll go right back to that line on the 1040. So if you remember that little sheet that I had showed you that will be in the Dropbox, where it talks about retirement income. So if you have a 1099R, you're going to go 1040 page 2. You can go to any one of the lines here, but basically line 4, hit F9, go in there, find your 1099R, and then you have your document, okay? And then we have a 1099R in our workbook at the bottom of 9-7. In this case, this is for the taxpayer, and it is very, very important. I cannot stress enough how important it is to make sure on 1099Rs that you get correct marking at the top, whether it's a taxpayer or a spouse. Because we're going to talk about some things on the state here in a second for state, what happens on the state, but you got to make sure, because if I check spouse on this one, and in this case, Elizabeth is not 59 and a half, and I put this under her, it would result in a penalty on the return, which is not true. This is for Elmer. So make sure you do taxpayer. We are going to do the address very much like we did the W-2 to verify it. We're going to put in the EIN number for My Pension is the name of the company here. Okay. All right, so we have that in there. And we are going to put in the $15,000 that he has as his distribution. In this case, we know what the taxable amount is. All right, so we have that. We have the $1,500 in withholding that shows up. And in this case, this is coded 7. So it's a normal distribution, okay? It's not from an IRA. If we look at box 12, 13, and 14, we have no state withholding. However, over here on the left, we have one little thing that we have to address, okay? And this is a New York State consideration. So right here, all right, okay, this is a little box that we have to address, all right? So in your book or your workbook or a piece of paper or a Post-it, we're going to explain what each one of these is, all right? Box 1, all right, this is for state considerations for New York. Box 1, you check that if the person is over 59 and a half, okay? Box 1, older than 59 and a half, okay? Box 2, all right? Box 2 means that it is a government, state, federal, local, but it is a government pension, all right? So box 2 is a government pension, all right? Box 3, future use, nothing for that. So box 3, future use. And then obviously box 4, this is railroad retirement. Box 4 is railroad retirement, okay? Box 1, over 59 and a half. Box 2, federal government, government type pension. Box 3 is not being used, and 4 is for railroad retirement, okay? So that's where we have on those. In this case, we have Elmer. Remember, we checked taxpayer Elmer. He is over 59 and a half, so we're going to check that box for him. Okay? Now, what that means is we're going to take a look and see where all this went. All right? First thing is we're going to go back to our 1040 page 2. All right? We can see $15,000 was the distribution. $15,000 is taxable. All right? So we have that. The other thing that we had is we did that little box. So we're going to go to our New York 201 page 2. Again, $15,000. However, under New York State subtractions, pension and annuity income exclusion. If the taxpayer reached 59 and a half during 2018, enter any adjustment on line 29 for pensions received prior. So basically what happens is in the state of New York, if somebody has pension, IRA, annuity type income, the first $20,000 is tax-free for each the taxpayer and the spouse. Okay? In this case, we have a $15,000 pension that is for Elmer. And in this case, that $15,000 is tax-free on the state of New York. That's why we checked that little box number 1. Okay? So if remember on the 1099-R, we're down here and we checked box 1, that took us and took $15,000 and excluded it from income on the state of New York. Okay? So basically, the only thing that shows up right now from the 2 documents as far as income for Elmer and Elizabeth is Elizabeth's W-2. Okay? Obviously, as it says here, you got to kind of prorate. So if somebody turns 59 and a half during the year, only the months that they are 59 and a half are excluded. So if I have somebody that, say that Elmer turned 59 and a half we'll say in June, okay? His $15,000 that he's getting on a monthly basis, all right? So he's getting $1,250 a month. So in this case, I would have to go down here and say, okay, I'm gonna hit F5, pops open my calculator, $1,250 times 6 months were not when he was 59 and a half. So you can see that now I can only exclude half of it because I was only 59 and a half for half the year. Okay? All right. All right, so we have that. Next document we have is for Elizabeth. Okay? So we have a 1099-R that we put in for Elmer. Remember, we can go up top. We can hit our copy. This one is for Elizabeth. All right? Remember, I told you to make note as far as for Elizabeth to make note on that age that we put in on the main information page. We have the address is good on here, okay? We have the EIN number for the brokerage or the pension or the IRA or whatever this is coming from. All right. Must be from a previous company she worked for. We have $10,000 that she had of income. We had $10,000, all right, here. Taxable amount not determined. We have to recreate that. $1,000 withholding. Now, in this case, this is an IRA that she has. It's a code 1, early distribution from an IRA, okay? And the other thing is we have state withholding, $320. Big thing on this is really pay close attention. Just like I tell you on the W-2s, make sure you pay close attention to that state withholding. Out of sight, out of mind. Sometimes it's lost down there at the bottom, okay? Now, our boxes. All right, can't do box 1. She's not 59 and a half. Okay, she was 58 during 2018. Can't do box 2, not a federal pension. It's not a railroad. So we can exclude nothing on the state. All right? We can exclude nothing on the state. All right? Now, what that means is she has an additional tax. All right? So let's go back up to our 1040 page 2, we can see here, we got her 10,000, Elmer's 15,000, 25,000. Okay? Now, if we go to Schedule 4 where it says Other Taxes, line 59, additional tax on IRAs, other qualified retirement plans, and other tax favored account, attach Form 5329 if required. Well, we're not required to do it, but basically this one is saying that we have that penalty. So on the left on our tree, you can see we have a 5329 for the spouse. All right, and here it is in Part 1, additional tax on early distributions. All right, so I have additional tax. My $10,000, my 10% penalty. Okay, now one thing I can do, and a lot of times I'll do this with my clients, why did you guys take the $10,000? What was the reason for it? And Elmer and Elizabeth might say to me, hey, we did it to buy a new house. Okay, well, I can exclude some of that. So if I look here, I go in here, I hit F1, all right, brings up a little help form for this. All right, and if I scroll down, I have exemption codes, exception codes, okay? If I look at exception code, and again, these sometimes are in the quick finder and everything, but I look at number 9, it says IRA distributions made for the purchase of a first home up to $10,000. Wow, they bought their first home with this. So I'm gonna put a 9 there, okay? Oops, gotta put 09. And I'm gonna exclude $10,000 that they can use. Well, in this case, what happened? I got rid of the penalty. So it's still a taxable distribution, but I got rid of their penalty, okay? So I'm gonna take that out of there because in this case, we're gonna keep the penalty on there, the $1,000, all right? So we have that, okay? So if we go back to our 1040 page 1, we can see our income, and then down here below, other taxes, we noticed that was on Schedule 4, there's that $1,000 penalty, okay? Now, the last document that we have here for Elmer and Elizabeth, Elmer's on Social Security, okay? So, on my 1040 page 2, line 5A, I have Social Security. So I'm gonna go in there, I'm gonna hit F9, I'm gonna go to my Social Security worksheet. All right, and then I can see up here Social Security and Railroad 1 tier benefits. Remember I said, pink and blue, boys and girls together. So my pink Social Security and my blue Railroad Tier 1, or the blue documents, they will go here. You can see that it all explains it there for which parts goes in. In this case, I have Social Security that he received. Again, I go to box 5, my pink box. All right, so we're in on that one. I go down to my Medicare, 1248. And I go down and it had $300 in tax withheld, okay? Now, on the federal, if we go back to my 1040 page 2, I can see here is my Social Security benefits, $10,760, but roughly little under half of it is taxable, okay? Up to 85% of your Social Security can be taxable. Because of their other income on the return, less than 50% is taxable, all right? On the state side, remember that number, 4964. We go to our New York page 2, there's that number, but Social Security is not taxable on the state. So we're gonna subtract that. So Elmer's 15,000 and his Social Security, basically he has no taxable income in the state of New York. The only taxable income that exists there is the income for Elizabeth, all right? Both her W-2 and her $10,000 distribution, all right? No penalty for early withdrawal on here. Really the penalty on the state side is the fact that it stays as taxable income. It's not excluded like it would be for somebody over 59 and a half, okay? All right. So that was our problem for Elmer and Elizabeth, okay? So we have that one, all right? Now, Give me 1 second here. If you want to turn in your book, and the next one we're going to do in the workbook so I can talk about some other things, is we are going to do, let me double check here. Okay, we're going to do problem 9.3. Okay, so we're going to do problem 9.3. All right, this one is Stan and Jennifer Wright. It is on page 913. So in your workbook, you can go to 913. Okay. All right. So we're going to do this one next. Okay. So my bullet points, if we take a look at them real quick, Stan and Jennifer filed at 10:40 last year. Okay. Maybe that means, and they were able to itemize. It does mean that. Okay. So we have a case that we have itemization here. All right. They received a $325 state refund. They don't have enough to itemize this year. Well, because they itemized last year, we're going to have to put that tax refund on as taxable income. If the Wrights get a refund, they would like a deposit in their checking account. If they owe, they'll write a check. They sold stock and brought the forms with them. They purchased stock long ago for which the broker could not provide the purchase information, but they have it. Micro stock, 200 shares purchased, September 17th, 1980, $31 a share plus $120 in commission. They had health insurance all year long. Okay, so we'll have to remember that. We're going to come back to that. We'll probably need that information a little bit later, but you know, we'll have to keep that in mind that we have information about the stock. Okay. All right. So we have Stan and Jennifer Wright. Okay. So we'll get their social security number in here. All right. I want to do that. Okay. Okay. Okay, so we have Stanley, whoops, I got blocked here. There, Stanley, no middle initial there for him. Okay, and we have Jennifer, and we have a middle initial for her, and her social security number. All right, we have 625 Oak Street for the residents. They're up in Youngstown. All right, and instead of being right, their email is wrong at gmail.com. We have a phone number for them. Okay, we have a cell number for them. All right, we have date of birth. All right, so we have somebody over 65, over 66 actually, so full retirement age for Social Security. They can take money out of a retirement account. We have a spouse that is the same. He is retired. She is retired and works part-time as a bookkeeper. Okay. All right, they're doing a married filing joint. They have emptied their nests, so we have no children. We're going to e-file their return. They were New York residents all year long. We have their bank information. They said they would like it deposited there should they have a refund. That would be their checking account. Again, 5 digits. Just use their zip code. Okay. Again, these first boxes for driver's license, we'll cover that later on when we'll do other problems. Put in your preparer ID and it'll populate everything for you. Okay, and again, we'll clean up their health insurance. They both had health insurance all year long. Okay, so no and no, since it was not through the marketplace, and then 12 months after there. All right. Okay, so let's head back up. We had one bullet point that was very important. It says Stan and Jennifer filed a 1040 last year. They itemized. So we're going to go to our Schedule 1, and this question says, did you itemize deductions last year and receive a state or local tax refund, credit or offsets? Yes, they did. Okay, and they received $325. All right, don't worry about the worksheet. It's not going to do you any good, so don't worry about F9ing in there, but you just put that amount right in there. Okay, if it does not go in there for you, have trouble typing it in, use the F8 key to override and put the amount in. But if you have it where it's red like it was when I put it in there, you just put that 325. So that means we have taxable refund because we itemized last year. All right. Okay. All right. Next thing we have, if we go to page 915. Remember we said Jennifer was working as a part-time bookkeeper, so she's retired but working part-time. So we have a W-2 for her. Make sure you check spouse. We have the address looks good. We're going to put in her employer's EIN number. Okay, she's working for Sears, which it's my understanding that the last Sears, after having a Sears in the Buffalo area for 70 years, the Sears at McKinley Mall is closing. So for the first time in 70 years, the city of Buffalo will be without a Sears store. So all you Craftsman tool fans better get down there, okay? We put our income in there. We verified that what we have is correct. Again, nothing on this. The 414H we'll talk about later, okay? In fact, I'm going to talk about it when we do one of the other problems next week that deals with retirement, because I'll talk about where that one goes, okay? We have New York withholding, which you had, and like I said, out of sight, out of mind. Sometimes it sneaks down there where you don't see it, okay? All right, next document that we have there on 915 is interest income. All right, well, maybe we haven't done one of those for a little bit, but if we remember Schedule 1, and this is a great thing again, that sheet that I showed you that put in the Dropbox, you know, it has that little area, that column that says what it is. So if you do interest, you put it in there. We're going to go to interest, all right. 1040 page 2, we got our interest. We're going to go and light it up. Hit F9, we got our Schedule B. So the next column will be Schedule B. And then we're going to go to the little b. Remember, Schedule B, interest and dividends go on the Schedule B, but never type on the B, okay? They go on, interest and dividends go on the B, but never type directly on the B. So we're going to go in there, hit F9, gives us a new interest statement. All right, so we can look at that. We have that there. This came from First. This came from First National Bank. All right. And in box 1 or 3, we had $321. Remember, there's no state adjustment on this. We didn't have any withholding, nothing else on here. So we have our First National Bank on there, so we got our interest in. Okay. Now, top of page 916, we have some brokerage. Remember, we talked about capital gains in Chapter 8. So we're going to see one of those in order. Okay. So, capital gains. All right. Let's go back to the 1040 page 2. Well, I don't see anything in the income section here that says anything. Let's kind of check our schedules. Well, schedule 1, and there's some income. Look at line 13, capital gains, schedule D. So we go over, capital gains, schedule D, light up the box on the right, hit F9. There's our capital gains worksheet. All right. So our schedule D, we have that. Again, we're not going to put anything on the schedule D. So the schedule B, interest and dividends go on the schedule B, but do not type directly on the B. Schedule D, we have capital gains and losses. We have capital gains. They go on here, but do not type directly on the D. What we're going to do is go down where it says short-term totals. There's a box with a yellow number. Hit F9. We have a capital gains worksheet. All right. So this is the sheet where all of our different transactions for capital gains are going to go. They will then flow to the 8949 and eventually to the Schedule D, and then finally to the 1040 page 2. But this is where we're going to do all this work on our capital gains. Okay. In this case, we have this stock. Smith Barney is our broker. All right. We look at 1A. We have a description there that says that it is, okay. One little point of fact, well, I'm jumping ahead here. When you get to this, I don't know why it always opens this way. I've asked everybody and nobody seems to be able to answer. But as soon as you get to this, I want you to scroll up, because as you see up here above this, we have some things where we have letters, short-term, long-term, basis reported, basis not reported, and neither apply. Okay, and we're going to have a column for that. So in this case, we're going to put in there, we have our micro stock. Okay, now this micro stock, if we look at this, all right, we have nothing in 1B and nothing in 1E. Okay, however, remember from our bullet points, it says the rights purchased a stock long ago for which the broker couldn't provide the purchase information, but they have it. Okay. That micro stock was 200 shares purchased September 17th, 1980. Well, that would be long term, okay? Because we sold it in 2018, purchased it in 1980. All right, so when we see that, we go, okay, so we're looking at letters D, E, and F. If we look at that, we say, okay, D, E, and F. Well, D says the bases were reported. Well, on my 1099B, it's not reported. I had to find it. Now let's go to E. The long-term transaction reported on Form 1099B, which I do have, and that's where the proceeds, but there was no basis. So I'm going to put this in as an E, okay? Now, once I did that E, if you look on your tree to the left, give me 1 second here. If you look on your tree on the left, right above my capital gains worksheet, you can see my 8949 is there, okay? So you can see how that created. I'm not typing on the 8949, not typing on the Schedule D. I'm using my capital gains transaction worksheet. Now, date acquired, it says that I received this September 17th, 1980. Oops. All right, and I sold it, as it says on the 1099B, May 3rd, 2018. I have my sale price of proceeds of $5,900. All right. And then it says here I had 200 shares, $31 a share. Okay. I use my calculator in here, so I'm going to hit F5. Gives me my little calculator. 200 times $31. All right. Plus $120. Okay. So there is my cost basis, all right? And then you can see over here, I had a loss of $420 on this transaction, all right? Okay. Okay, so we have that, all right? Now, my next transaction, my next one is, if you look at the bottom of page 916, I have another 1099B. This one is 200 shares of SBC. Okay, I acquired it in 1985. All right, and I sold it in 2018. So that's telling me long term, greater than a year. But I do have the cost basis. So in this case, I have a D. All right, so I have a D on there. Okay, it was 1985. I have it sold in 2018. I have my proceeds. I have my cost basis. So on this one, I had a gain. Okay, and if we look on our tree on the left again, right above our capital gains worksheet, now I have another 8949, one for my long term that's coded D, one for my long term coded E. Okay, all right. Now, going to page 917, we have another one. This one comes from Vestro Wireless, okay? All right. Now, looking at my code, I acquired this December 24th, 2017, and I sold it 10/24/2018. Now, yes, the year makes it look like a year, but since I acquired it December 24th, 2017, 1 year would be December 24th, 2018. I sold it before that year. So this is a short term, all right? You can see it's marked that way on the 1099B, but we need to validate it with the dates, all right? And the basis was reported to the IRS. So we have on that a letter A, okay? We had it bought 12/24/2017, sold 10/24/2018, okay? I have proceeds of 15,356. I have cost basis 17,450, okay? So I lost on this one, I lost $2,000, okay? But again, we look at our tree on the left, now we have a third 8949, okay? All right, so if we look at each one of those, there's our short-term one that we just put in. There's our SBC stock on a separate one. And then there is our 8949 on a third one. All of those were created from our transaction worksheet. If I go up a layer to my Schedule D, I can see the totals. Here's my long term. Here's my short term. Okay, or excuse me, short term and long term. Okay, and I can see there's a line for each of them, whether they're D's or E's or whatever it may be. I can see my losses. All right, so we have that. Okay. All right, last document we have here on the bottom of 917 is a Social Security statement. So we're going to go back to our 1040 page 2, line 5A. Again, Social Security on that little sheet that I showed you that I'll put in the Dropbox, right? Social Security, 1040 page 2 or 1040 line 5A. I'm going to go in there, hit F9. Then you might want to put on there 1040 worksheet 1. That's my Social Security. In this case, we had $12,600. Okay. We had $416 for Medicare and tax withheld of $1,260. Okay. So we had all that on there. All right. All right. So we have everything there. Okay. So we got all of our tax documents in. I'm just going to talk about a couple extra things on this one with the capital gains. Okay. Down here. All right. So we have this. Okay. But we have on here that we're going to say that they sold their house and they did not live in it to meet the exclusion. So they didn't live in it at least 2 of the last 5 years. So, but they did live in it for more than a year. So we're going to have an F for long term. All right. Actually, what we're going to do, we'll do it this way. All right. Next door was mom and dad's house. All right. And they inherited it. Okay. And they sold it at the end of the year. All right. And they sold it, and it was a house that, you know, was next door. They didn't want to do it. None of the kids wanted it. So they sold it for $100,000. Okay. It needed some work. All right. Okay. And the fair market when mom and dad passed was $110,000. So they took a little bit of a loss. Again, not their primary residence, so they can take a loss. So we have a $10,000 loss. All right. Okay. Again, we added a new one here. We have on our Schedule D, we see that we have, you know, a $9,000 loss and a $22,000 loss. But when we go to Schedule 1, we see $3,000. So the sale of that house, of mom and dad's house that I inherited, then we have a limit of $3,000 a year that we can take. Now, if we go to the Schedule D, Worksheet 2, we can see here, there's my loss, there's what I took, all right? So that means I have a carryover, okay? Okay, good question there. Paul had a question about mutual funds. I'll show you that in just a second, okay? All right. So you can see our carryover loss here on that. That's going to carry over to next year, all right? Now, if I have, in the case of our stocks here, everything came from Smith Barney, all right? And say that I had a brokerage statement that had several transactions on it, okay? And it was a stock that was bought, you know, 20 different dates, okay? But I sold them all in one day. So we could go in here and put Smith Barney, all right? We were going to say they're all held longer than a year, and the basis reported, so we got a D, okay? And as opposed to typing in each and every one of those transactions, okay, each stock transaction, all I have to do is put the letter V in there, various. So that could mean I could have 12 dates, but I sold the whole lot of the stock at the end of the year, and I can put the total of what I got for it, and I can put that $15,000, okay? So I can show my stock. So you can do, as opposed to having to type in every transaction, if you have several long-term with basis reported, you can put them all together as a total, hit various, and put that in there as the total on the 20. So an example of this, if you take a look at that handout that's in the Dropbox, okay, I have short-term transactions covered tax lots. So those are A's. And you can see I have 4 different stocks here. But at the bottom, I have a total, 83, 150, 240. Okay? In a case like that, all right, in a case like that on the handout, you know, I can put that number in there. So even if this Smith Barney was 4 different stocks, I got in different days and sold them all, I can put that in there. Okay, so you can kind of recap, you know, more than one line of a transaction. And as you do more problems, you get in the office, you get somebody's brokerage account, you'll get more and more of this. Okay, so that's what we do with those. So let me take that. Okay, so we have those. Whoops. All right, and that was the last of that information on there. Okay, all right. So we covered a lot of stuff. We covered capital gains. We have to know the basis, as we see here on our capital gains worksheet. What did we pay for it? What was the value when we inherited it? When we took possession or when we bought it? Okay. We talked about personal residence. If you're selling your personal residence and you lived in it and owned it for at least 2 of the last 5 years, you can exclude that 250 or that 500,000 married filing joint. Okay. We talked about stock transactions. We have to determine on the 1099-B, did we get the basis, the value, or did we have to look it up? Was it short-term or long-term? Okay, so we determine that. If we have losses for a year, we can only use 3,000 losses and carry everything else forward. All right, so we have everything on that. Then chapter 9, we got into retirement, qualified accounts, okay, tax-free on the way in, tax-free on the way out, non-qualified, tax dollars on the way in, tax-free on the way out. We talked about Social Security, up to 85% is taxable, and that goes on the return. We talked about a lot of various things, okay? All right, so we covered a lot of stuff today, all right? So I hope that the recording, you'll be able to come back and review it. Again, we're going over a little bit on time, but, this was a lot of material. I apologize, and like I said, with the reading, it's a lot. I try to hit the main points that's going to get you 95% of what you're ever going to do. The rest of it kind of reference for special scenarios. Once you're working for us, I'm your phone a friend. So you can call and say, hey, how do I do this? And I can probably either log into the computer where you're working or just walk you through it or tell you where to find the answer. So I can help you on that. Okay. All right, so I'm going to send out, make a YouTube clip of this. I will then send that out to everybody with the homework assignments. Keep working on those. Everybody's doing great on them. Again, as I emphasized in the last one that I sent out, I put there at the bottom, if you get any of these returns that you're getting done, I'll send out the answers, for chapter 6 and 7. But, for some of these returns, as you get them done, say, hey, can you send me or put in the Dropbox the PDF printout for what we did, Stanley and Jennifer, right? Yeah, Stanley and Jennifer Wright. If you wanted me to drop the PDF in there, I will, okay? I hope everybody has a good weekend. Make sure you're battening down the hatches. Sounds like record cold. They're talking about the coldest temperatures for this time of year in 170 years. So make sure the firewood's split, the furnace is working, extra blanket on the bed, and keep everybody warm. But we'll see you next week. Again, keep turning in the homework during the week. Everybody looks like they're doing great on it. And then we'll meet next week and go through a couple more chapters. Like I said, I'm trying to spend more and more time in the problems after we cover the tax stuff so that you can see the tax law in action on the actual forms and tax returns so you can understand the calculation. All right. Thanks for everybody being here. Again, we'll see everybody next week.